everyone, and welcome to the Future Minds Bootcamp. My name is Rika Dry, and today we're diving into one of the most exciting foundations of accounting, the accounting equation. By the end of this video, you'll understand how business owners obtain funds to open their businesses or expand, how to determine how much they own, what they owe, and how much the business is worth. You will also know how to determine what accounts should be debited and credited, and what constitutes assets, liabilities, and equity. Let's get started. Let's imagine you're about to start a small business, maybe a tuck shop at school. You're excited, you've got ideas, and you are ready to earn some money. But wait, how will you afford a fridge or the inventory of cold drinks and chips before you've sold anything? The business has not made a cent yet, but you still need to buy things. This is where we start to think about how businesses are built, using a mix of money from the owner or even loans from others. Once your business opens and starts running, how do you know what's actually yours as the owner? You've bought things, maybe taken a loan, and hopefully sold some products too. But how do you calculate your share, your value in the business? That's where we introduce the concept of equity. Equity tells us how much of the business truly belongs to you, the owner, after debts are paid off. This is the starting point of the accounting equation. Let's start to get to know what assets, liabilities, and equity is. Let's look at the first important part of the accounting equation, assets. The formal definition of an asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. But what does that mean? That means that assets are things a business owns or controls, things that help the business earn money, or in other words, brings in future economic benefits. For example, in the case of the tuck shop, the fridge helps keep the cold drinks cold, and that helps the business to sell ice-cold cold drinks on a hot day. Examples of assets are the cash in the business bank account, inventory, for example, the cold drinks or other snacks that the tuck shop can sell, equipment like a computer or the fridge, or a delivery scooter. Can you think of other examples of assets? Maybe some of the stuff that you own, the clothes you are wearing, the shoes, the bag you use to carry your books to school. Maybe you participate in some sport and own a soccer ball or a cricket bat or a tennis racket. Those can all be considered assets that you own at this point, even though you don't have a business. But those are assets because you can choose to sell them, and that will bring in an economic benefit to you. So here's an easy way to remember it. Assets is the awesome stuff you own. If it helps you run the business and brings value, it's probably an asset. Now we move to the second part of the accounting equation, liabilities. The formal definition of liabilities are a present obligation of the entity to transfer an economic resource as a result of past events. That basically means that you did something in the past that caused you to owe somebody money. So, for example, you could have borrowed money from your parents, and now you have an obligation to transfer some of the economic resources in the business to your parents to repay what you owe them. Another example of a liability is the money you owe to a supplier after buying inventory on credit. Even though the business may have the fridge and inventory, you haven't paid for them yet, and then it's still a liability. Easy tip: liabilities is something that you will pay later. Liabilities reduces the value of the business for the owner because they still need to be paid off. But let's just stand still here for a little bit. You may have heard the terms current and non-current used to describe assets and liabilities. Today we are only going to explain what it means for liabilities, and you can then apply the same principle to what you already know about assets. If we say that a liability is a current liability, then it means that the liability will be paid back within 12 months. And therefore, it means that when a liability will only be paid back after 12 months, it will be called a non-current liability. Let's talk about equity, the third and most personal part of the accounting equation. Equity is the owner's share in the business, or the net worth of the business for the owner. If you invest your own savings to get started, that is called capital and forms part of equity. When the business makes a profit, it increases your equity. And if you take money out of the business for your own personal use, it lowers equity. If the business makes a loss, it also reduces your equity. So equity changes based on how the business performs and how much the owner is involved financially. Equity can be calculated in two ways. The first way, you can say equity is equal to all the capital contributions made by the owner less all the drawings, so the money the owner took for own use, plus all the income earned by the business, less all the expenses paid by the business. The other way is to use the basic accounting equation. Equity is equal to assets less liabilities. The second formula tells you once I've paid all my debts, what's left is mine. That's your equity. It's a great way to measure the true value of your business. What is a capital contribution? A capital contribution is anything that the owner contributes to the business. This contribution can be made as part of starting the business, but it can also be made at a later date when the owner, for example, feels it's needed to expand the business. This capital contribution can be made in the form of a cash transfer into the business's bank account, but the owner can also contribute a computer, for example, to record the financial accounting transactions of the business, or maybe a delivery van to assist with making deliveries of inventory sold. What is drawings? If the owner takes money out of the business for personal use, for example, to pay his or her own cell phone account, or maybe to put fuel in their car, then that is called drawings. Drawings reduces equity. What is income? Now, income is the most exciting part of having your own business. Income is the money that the business earns from selling inventory or delivering services. The more income you earn, the bigger profit you make. And the bigger the profit you make, the more equity increases. And an increase in equity means that the business is worth more for you as owner. What is expenses? These are the costs of running the business. The rent paid to the school where you are operating the tuck shop, or wages paid to friends who are helping you to sell inventory, or the electricity you are paying because you're using a fridge. Expenses reduce the profit, and that lowers the equity. When equity is lowered, it means that the net worth of the business is less for the owner. So just a quick recap. Equity increases when the owner invests money or the business earns income. And it goes down when you as an owner take out money or spend it on business costs. Simple, right? We have now had a look at the different elements of the accounting equation, namely assets, equity, and liabilities. But what is the accounting equation? The accounting equation is a mathematical equation where we can say that assets equals owner's equity plus liabilities. And it should always balance. So if we add something to assets, it means we had to get the funding from somewhere. Did we fund the purchase of the asset through owner's equity or through liabilities? So let's have a look at an example. Let's meet Zanele. She wants to start a cupcake stand. She has 200 Rand of her own savings, and her aunt lends her another 300 Rand. That gives her 500 Rand to buy her ingredients and tools. This is a perfect example of assets equals equity plus liabilities at the beginning. Zanele had 200 Rand that she contributed, that is capital or equity. Her aunt lends her another 300 Rand, that's liabilities. So our equity plus liabilities are equal to 500 Rand. And therefore she now has 500 Rand cash, and the cash is assets. So assets equals equity plus liabilities. Whether you're a kid with a cupcake stand, or a tuck shop, or a big company, the accounting equation always works. Assets must always equal equity plus liabilities. If it doesn't, it means that you somewhere made an error. So go back and double check how you recorded your assets, your equity, and your liabilities. After recording the transactions where Zanele contributed money to the business and borrowed money from her aunt, our accounting equation balances. And now Zanele can go to the store and buy her tools and her ingredients to start baking before she sells her first cupcakes. From there, she will have to apply the principles of the accounting equation to record her expenses, the purchase of her assets, and her income from selling cupcakes. The next thing from the double entry principle you need to know is how to apply the rules of the accounting equation. This is something that you need to learn off by heart. The basic foundation of financial accounting. So assets increase on the debit side and decrease on the credit side. The debit side is the left-hand side of a general ledger account, and the credit side is the right-hand side. Then equity increases on the credit side and decreases on the debit side. And liabilities also increase on the credit side and decrease on the debit side. So what does it mean? An asset, so for example, if you buy a computer, it means your computer equipment will increase. Therefore, computer equipment will be debited. But if you paid with it from your bank account, the cash in your bank account will decrease. The cash in your bank account is also an asset. So then assets will decrease on the credit side, so your bank account will be credited. When we look at equity, if the owner contributes money to the business, then equity will increase on the credit side. But if the owner, on the other hand, withdraws money, so drawings will then decrease equity, and that will be debited. A liability, so if we think back to Zanele, the money that she borrowed from her aunt will increase liabilities. So the loan from her aunt will be credited. If Zanele now pays back the loan from her aunt, the liability will decrease, and that repayment will be recorded on the debit side. But we are now going to have a look at an example. Each transaction affects two accounts. That means that one account will be debited and another account will be credited, but it should be done in such a way that our accounting equation always balances. Example 1. The owner deposits 1,000 Rand cash into the business bank account as capital contribution. Step 1. What accounts are affected by this transaction? So the owner deposits cash as a capital contribution. So we know that the one account is capital, which falls under equity. The next account is our bank account because the cash was deposited into our bank account. So step 2, do these accounts fall under assets, liabilities or equity? So we already established the capital contribution falls under equity and the cash deposit is into the bank account. Bank is an asset. So step 3, does this transaction increase or decrease assets, liabilities or equity? So the deposit of cash into the bank account will increase the cash in our bank. So assets increase. A capital contribution increases equity. If we now record this transaction on the accounting equation, the account debited will be bank because bank as an asset increases on the debit side. The account credited will be capital because equity increases on the credit side. So assets will be a plus 1,000 and equity will be a plus 1,000. And if we then look at our accounting equation, assets equals equity plus liabilities. Our assets is 1,000 Rand and our equity plus liabilities is 1,000 Rand. Therefore, this transaction balances. Example 2. Buy a computer on credit from SA Computers for 8,999 Rand. What accounts are affected by this transaction? So firstly, it will be computer equipment because we purchased a computer. But now it says on credit from SA Computers. That means SA Computers gave us a loan. So we are going to call this trade and other payables. Do these accounts fall under assets, liabilities, or equity? So a computer is an asset. Buying it on credit, so we got a loan, means it falls under liabilities. Does this transaction increase or decrease assets, liabilities, or equity? So we gained a computer, so computers increase, so our assets increase, but we owe SA Computers more money, so our liabilities also increased. So if we now record this transaction on the accounting equation, our account debited will be computer equipment because assets increase on the debit side. Trade and other payables will be credited because liabilities increase on the credit side. So we will say assets plus 8,999 Rand. Equity was not affected, so it will be 0. And liabilities will increase by 8,999 Rand. If we now go back and say assets equals equity plus liabilities, we will see that 8,999 Rand is equal to 8,999 Rand. Let's move on to example 3. Sell inventory for 500 Rand. The customer paid with a debit card. So what accounts are affected by this transaction? We had sales and we received money from the customer. So it will be sales and bank. Do these accounts fall under assets, liabilities, or equity? So we know that our bank account falls under assets and income falls under equity. So the sales will fall under equity. Does this transaction increase or decrease assets, liabilities, or equity? So the fact that we received income will increase our assets and income increases equity. So if we now record this on the accounting equation, we will debit the bank account because assets increase on the debit side, and we will credit the sales account because equity increases on the credit side. So plus 500 Rand under assets and plus 500 Rand under equity. And our accounting equation balances assets equals equity, 500 Rand and 500 Rand. Now this transaction is slightly more complicated because we actually need to record the cost of sales as well. But I'm going to leave you with that idea and you can go ask your teacher what to do with cost of sales. Example 4. Pay 350 Rand with an electronic funds transfer for the placement of an advertisement in the local newspaper. What accounts are affected by this transaction? We paid money, so it's the bank account. And what did we pay? We paid for an advertisement, so our other account will be advertising. Do these accounts fall under assets, liabilities, or equity? So our bank account will fall under assets. Advertising is an expense, and we learned that an expense falls under equity. Does this transaction increase or decrease assets, liabilities, or equity? Our bank account will decrease because we paid money, so we now have less cash in the bank account. And expenses decrease equity. Let's record this transaction on the accounting equation. The account debited will be advertising because equity decreases on the debit side. And the account credited will be bank because assets decreases on the credit side. So under assets, minus 350 Rand, and under equity, minus 350 Rand. And after doing that, our accounting equation still balances because we have minus 350 Rand under assets and equity plus liabilities is equal to minus 350 Rand. Example 5. pay 600 Rand with an electronic funds transfer to SA Computers as down payment on our account. What accounts are affected by this transaction? Firstly, it will be our bank account because we paid money from the bank account. And the second account will be trade and other payables because we repaid money we owe to SA Computers. So do these accounts fall under assets, liabilities or equity? Our bank account falls under assets. And trade and other payables control falls under liabilities. Does the transaction increase or decrease assets, liabilities or equity? So we paid money from our bank account. That means our bank account decreased. And we repaid some of the money we owe to SA Computers. So the liability will also decrease. So let's record it on the accounting equation. Trade and other payables will be debited because our liabilities decrease on the debit side. Our bank account will be credited because bank as an asset decreases on the credit side. So minus 600 under assets and minus 600 under liabilities. And once again, our accounting equation balances. And that brings us to the end of our video on the accounting equation. Remember, every business keeps track of what it owns, what it owes, and what's left for the owner. That's the power of assets equals equity plus liabilities. Thank you for joining me. I hope you feel a little bit more confident and maybe even inspired to explore more about accounting and business. Until next time, keep learning and stay curious.